OpenAI just filed its draft IPO prospectus confidentially with the SEC, with Goldman Sachs and Morgan Stanley running the deal, and a target valuation is $1 trillion. ChatGPT has 900 million weekly active users. The company grew from $6 billion in revenue in 2024 to a projected $29 billion in 2026. And when it lists, likely in September, it will be one of the most watched IPO events in stock market history. But here's the problem. You cannot buy a single share of OpenAI today. Not through Schwab, not through Robinhood, not through Fidelity. It is, after all, a private company. And when it does list, the CFO has confirmed retail investors will get an allocation. But the last time OpenAI opened a round to individual investors, the retail tranche was 3 times oversubscribed. Demand will far outstrip available shares. So, what do? Well, the good news is some of the companies that own OpenAI, build the chips it runs on, and profit most directly from its growth are already public. There are ETFs built around exactly that ecosystem, and one of them is up 65% in 2026 alone. My name is Phoebe, and you're watching Trading Key. Why OpenAI's valuation is both justified and terrifying. Before we get to the ETFs, you need to understand what you are actually trying to get exposure to, because the valuation math is not as straightforward as the headlines suggest. OpenAI generated $20 billion in revenue in 2025 and is on track for $29 billion in 2026. ChatGPT Plus at $20 per month, ChatGPT Pro at $200 per month, enterprise licensing, and API access collectively serve 50 million paying subscribers and over 3 million developers making 2 billion API calls per day. Those are not vanity metrics. The business is real and it's scaling fast. The challenge is what sits on the other side of the ledger. OpenAI projected a $14 billion operating loss in 2026 and may need over $200 billion in additional capital before it reaches profitability, which analysts currently place at 2029 to 2030 at the earliest. Gross margin sits at 33%, held down primarily by inference costs. Think of inference costs as the electricity bill for running ChatGPT. Every time a user sends a message, OpenAI pays for the compute required to generate the reply. In 2025 alone, that bill came to $8.4 billion. In 2026, it rises to $14.1 billion. At a $1 trillion valuation, OpenAI would trade at approximately 40 times its projected 2026 revenue. For context, Google trades at roughly 6 times revenue, and Microsoft trades at roughly 13 times. The market would be pricing OpenAI as if it will eventually control the economics of the entire AI transition. You can argue that that might be right, but it also might not be. What is certain is that OpenAI spending on compute flows directly to NVIDIA. Its enterprise growth drives Microsoft's Azure cloud business, and its API ecosystem runs on chips from Broadcom, AMD, and Micron. The companies extracting reliable cash from OpenAI's ambition are already public, and in several cases already reflecting that growth in their stock prices. Why pre-IPO OpenAI access is more restricted than it looks. There are 2 ways retail investors technically can get pre-IPO OpenAI exposure today. Now, understanding why each one is unsuitable for most people is the clearest argument for the ETF approach. The first route is secondary market platforms like Forge Global, EquityZen, and Linkto. These allow accredited investors to buy and sell existing OpenAI shares from early employees and investors. As of filming, the current secondary price is approximately $732 per share. The catch is that you must be an accredited investor, meaning $1 million in net worth or $200K in annual income, with position minimums typically starting at $50,000. And unlike a public stock, you cannot sell whenever you want. Liquidity depends entirely on finding a buyer in a thin private market. The second route is the ARK Venture Fund, ticker ARKVX, one of the only investment vehicles that holds OpenAI directly at roughly 11.5% of its portfolio. But ARKVX is not available on mainstream retail brokerages like Robinhood, Schwab, or Fidelity. You need to purchase it directly through ARK, or through the small number of platforms that carry interval funds, which already rules out most retail investors. And for those who do get in, exiting is just as difficult. It isn't a standard exchange-traded fund, but an interval fund, meaning redemptions are only permitted quarterly. You cannot sell your position on any random Tuesday the way you would a normal stock or ETF. There is also a cautionary example worth knowing before you start searching for alternatives. A vehicle called Destiny Tech 100, ticker DXYZ, holds a basket of pre-IPO tech companies, including OpenAI, and trades on a public exchange. For a while, retail investors poured into it because it offered public market access to private tech names. At its peak, DXYZ was trading at a premium of over 20% above the actual value of the assets it held, but it has since crashed more than 80% from that peak. The lesson here is not that the underlying assets are bad. The true lesson is that when something becomes the only public vehicle for retail access to a hyped private company, price disconnects from reality very quickly. The 4 ETFs that give you real OpenAI ecosystem exposure. I'll need to preface again that none of these ETFs hold OpenAI stock because OpenAI isn't yet public. What they hold are the companies that supply OpenAI's infrastructure, own meaningful equity stakes in it, or are positioned to capture the same secular tailwind that makes OpenAI worth $1 trillion in the first place. Let's start with the one that has already delivered the most. SOXX, the iShares Semiconductor ETF, is up 65% in 2026 as of last week, with an expense ratio of just 0.34%. It holds 34 semiconductor companies including NVIDIA, Broadcom, AMD, and Micron. The thesis is straightforward. OpenAI's 2026 compute budget is $14.1 billion, and every dollar flows through the chips these companies make. NVIDIA's $75.2 billion data center quarter reported this week was partially funded by OpenAI's growth. SOXX is not a bet on OpenAI winning the AI race, but a bet that AI compute demand keeps expanding regardless of which AI company leads, and that bet has paid out consistently since 2024. Next is Chat, the Roundhill Generative AI and Technology ETF. This is the most concentrated pure-play option in the group. Actively managed, it holds roughly 30 stocks selected specifically for generative AI exposure and has returned 122% over the past 12 months. Top holdings include NVIDIA at roughly 7%, Alphabet at 6.7%, and semiconductor memory names like SK, Hynix, and Micron. The expense ratio is 0.75%, the highest in this group. Chat is the most deliberately constructed ETF around the generative AI theme, which also makes it the most likely vehicle to add OpenAI as a meaningful position once the IPO closes. Third is AIQ, the Global X Artificial Intelligence and Technology ETF. Broader than the others, it holds 90 companies across the AI ecosystem and carries approximately $8.6 billion in assets, up roughly 24% year-to-date at a 0.68% expense ratio. What makes AIQ particularly relevant to the OpenAI story is its Microsoft exposure. Microsoft owns approximately 27% of OpenAI, a stake currently worth roughly $228 billion at the private round valuation. That OpenAI equity is embedded in every share of AIQ that holds Microsoft. For investors who want AI ecosystem exposure without concentrating too heavily in any one name, AIQ captures both the chip supply chain and the single largest public market proxy for OpenAI equities simultaneously. Fourth is QQQ, the Invesco Nasdaq 100 ETF. This isn't an AI fund, but the largest Nasdaq index fund in the world, with roughly $400 billion in assets and an expense ratio of just 0.2%. Its top 5 holdings include NVIDIA, Microsoft, Alphabet, Apple, and Broadcom, giving it significant indirect OpenAI exposure through Microsoft's equity stake and NVIDIA's supplier relationship. There's another reason QQQ is worth naming here specifically. When OpenAI lists on NASDAQ and eventually qualifies for NASDAQ 100 inclusion, QQQ will automatically hold it as a top position. Buying QQQ today is implicitly also positioning for that eventual inclusion without paying a premium for a pure-play AI fund. Here's a bonus stock worth mentioning separately as a data point rather than a recommendation. Microsoft is the most direct public market proxy for OpenAI ownership, with its 27% stake worth $228 billion. And yet Microsoft is down approximately 13% in 2026, underperforming every AI-themed ETF in this group. The market is discounting the OpenAI value because OpenAI has capped Microsoft's revenue share at $38 billion, and the relationship is shifting from financial partner to paying cloud customer. The profits now flow to OpenAI, not back to Microsoft shareholders. Owning Microsoft for OpenAI exposure may work eventually, but the market is telling you the timeline on that value unlock is unclear. How to think about this? Before the OpenAI IPO. A few honest principles for thinking about allocation before September. SOXX leads this group at 65% in 2026. For contrast, BOTZ, the Global X Robotics and AI ETF, focused on industrial automation rather than generative AI, is down 2% over the same period. That gap illustrates the most important thing to understand before buying any AI ETF. The category is not monolithic. Industrial robotics and generative AI have been in completely different markets this year. Know exactly what the fund owns before you buy it. On the spectrum of options here, QQQ is the cheapest and most liquid at 0.2%, and it will automatically incorporate OpenAI once it qualifies for NASDAQ 100 inclusion. Chat is the highest conviction generative AI bet at 0.75%. AIQ is the best single fund proxy for indirect OpenAI equity through its Microsoft weight. And SOXX is the purest compute infrastructure play and the strongest performer in the group. Again, none of these are a substitute for buying OpenAI at IPO. If you're able to participate in the IPO allocation, the CFO has confirmed retail shares will be available, and demand from individuals has already been 3 times oversubscribed in private rounds. Getting a meaningful allocation will require using a brokerage that participates in IPO programs and acting early once the roadshow opens, likely in late August. If you don't get an allocation or prefer not to buy on day one, the history of major AI IPOs suggests patience is rewarded. Owning the infrastructure OpenAI depends on has outperformed owning the company itself in 2026. SOXX at 65% year-to-date is the most compelling argument for that thesis. So, which of these are you already holding? And is the OpenAI IPO on your watch list for September? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.